All right, so today I'm going to be talking about a paper that's kind of similar to what Robert was presenting, but coming at it from a very different angle. We're going to be looking at a very different type of small enterprise, looking at venture capital-backed innovative companies. And the question that we're trying to address in this paper is how the COVID-19 pandemic impacted the flow of financing to these innovative small companies, these innovative small enterprises. This is an important question for two reasons. Well, one, because we think that innovative companies are in general important. We think innovation matters a lot. And two, because innovation might be especially important in a crisis. Whether this is coming up with better ways to communicate, the next Zoom ways to communicate within companies, within social groups, or whether this is medical innovation, we might think that these things are sorely needed during COVID, during this time of disruption. So what did we do? Well, we surveyed about 1,000 venture capitalists. The key question is, did COVID cut off the supply of innovative financing or not? How were venture capitalists and how were the companies that they funded impacted by this pandemic shock? To answer this, we surveyed more than 1,000 venture capitalists. We asked them a variety of questions about how they reacted, about how the innovative companies that they're funding were impacted, and about how their relationships with the limited partners that give them money were impacted. So asking both about how venture capital to portfolio company interactions changed, how portfolio companies were impacted, how venture capitalists were impacted, and then moving up a level, how the interactions between venture capital funds and the pension funds or university endowments that give them money, how those were enacted. Our survey was conducted over about 2 weeks in late June, early July 2020. It was a time when COVID was, say, controlled or appeared to be controlled in Western Europe and most of Asia. It was a growing threat, a growing worry in the US. This was a time of greater uncertainty, or perhaps more optimism. I think at that point, a lot of people thought that COVID would be done in 3 months, not another almost year of lockdowns and third and fourth and fifth waves. What we're going to be doing is we'll be talking about the results, how venture capitalists responded, how they were acting differently during this time of higher uncertainty, contrasting that to a prior survey that we did about 5 years ago, asking the same type of questions about venture capital decision-making. And also coming up, we're going to be adding in another wave of survey responses, asking how venture capitalists have changed their responses, or how venture capitalists have changed their decision-making now, a year into the pandemic. So our survey was targeting venture capitalists, like I said. We emailed many of them. We got responses from about 1,000 of them. These include about 800 institutional venture capital firms. So think an independent partnership with 4 partners channeling money from pension funds into innovative companies. We also have about 112 corporate venture capitalists. So corporate venture capital arms are going to be captive. They're going to be tied to a corporation. Think Google Ventures or IBM's venture arm or Seven Ventures with 7-Eleven, investing money on behalf of those companies, either to further the innovation agenda of those companies, to give them information. There's a variety of reasons for this, but they have a very different source of funding and a very different mission and a very different structure. Our respondents included some of the very best firms, none of the top 10 as ranked by Deals, 35 of the top 50. So we managed to capture a wide cross-section of firms ranging from non-US to US to California to not California to the very best to firms that I guess no one here has ever heard of. And we're going to be trying to exploit that variation, looking at how corporate tied venture capital funds behave differently from independent funds, how industry mattered, whether healthcare was more or less affected than IT, stage, early stage, very young, innovative companies versus older, still innovative but more mature companies. Think something like a pre-IPO company versus a startup with 3 people and a dog in a garage. We're also going to be looking at location, looking at the US versus international, looking at California versus the rest of the US. Because in the venture capital world, California is a bit of a special case because of so much innovation activity being focused there, so much supply of capital, and that leading to a great abatement of frictions in that region. And finally, we're going to be looking at the extent impacted by COVID-19. We're asking venture capitalists how much COVID impacted them. How did the venture capitalists who say COVID had a big effect on their portfolios. What's different about them? Is there anything special about these most impacted venture capitalists? Were they behaving differently? So starting out with a general question, how did VCs expect COVID to impact their investments going forward? We see a significant decline in their expected investments, about 30% at the beginning of the pandemic, and they thought that their investment rate going forward would be down about 20%. So the flow of innovative financing is down by approximately a quarter. Is that big? Is that small? I think that's perhaps less than many other industries, less than certainly travel or hospitality. It seems to be perhaps what we'd expect given the other papers today. Ballpark, maybe it's the same magnitude as the dividend cuts, maybe same ballpark magnitude as the revenue losses Robert was talking about, a decline, but not a crisis. And this is interesting, or at least interesting to me, because this is such a highly speculative area. There are so many potential frictions here, ranging from VCs' reliance on face-to-face meetings, on judging entrepreneurs for personal qualities, to the high level of risk, the high level of uncertainty, that we could have expected a larger decline, or perhaps less of a decline. So diving in. All right. So diving into why VCs say they're investing less, well, we asked them, was this because they couldn't evaluate deals? Were they trying to conserve capital, conserve dry powder to fund future rounds or fund future startups? Whether they're shifting towards safer startups, those closer to profitability, trying to de-risk, or whether they're just meeting fewer quality entrepreneurs, whether lockdowns and mask mandates have made it impossible to connect with entrepreneurs. And perhaps surprisingly, the result we're getting is that a struggle to evaluate deals was the main friction VCs report as leading to a declined investment rate. VCs say that they are not investing because they cannot evaluate the portfolio companies. And this is suggestive of waiting as a real options strategy. If you go through classic real options models, when there is going to be a short-term increase in volatility, it's often better to wait, to defer investment, wait for that uncertainty to resolve. In the context of VC, this could mean waiting for some of the pandemic uncertainty to resolve before deciding which startups had potential and which didn't. You don't want to invest in a startup promising a vaccine cure if COVID is going to get resolved quickly. You don't want to invest in a startup that is going to be all in on hospitality if COVID is going to take another 2 years. The second reason that came up is a desire to preserve capital. So venture capital funds and corporate VCs are both drawing capital from entities that may have a higher need for capital during times like a financial crisis or like COVID. This wasn't especially popular. There's going to be some evidence that LPs were feeling the crunch from this uncertainty, but where we really saw this power, where we really saw conserving capital being a priority was corporate VCs. And perhaps this is going to be consistent with what we saw earlier on dividend cuts by some companies. Corporate VCs, this type of investment that's kind of outside the mandate of the corporation, seems to be something that is being one of the first things on the chopping block. These corporate VCs were much more, saw conserving their parent corporation's capital as a much higher priority than the independent VC funds did. So how did cost of capital change? Are innovative ventures being starved for financing? Well, not really. We saw a small increase in IRR, up from about 31% to about 34%. So those numbers might seem staggeringly high if you think about cost of capital calculations and weighted average cost of capital. But these are sort of ballpark typical in the venture capital industry, where we're building in not just systematic risk, but the possibility of many ventures failing. So venture capitalists saw an increase in risk and an increase in uncertainty, responded by slightly increasing their hurdle rate, but perhaps not that much. This shows some evidence of the cost of capital channel, but there's other possibilities here. This could be just due to the risk increase. This could be due to better investment opportunities as seen by venture capitalists, or an option to wait, an option to learn. And we see some evidence in terms of the limited partners, in terms of the pension funds that put money into VCs, some evidence those limited partners were concerned about capital allocation, concerned about liquidity, and pushing venture capitalists to withdraw less money. But more of that coming from the corporate vehicles, perhaps because of those closer ties to capital-constrained corporations. If we think about this, this suggests a world where the within corporation cost of capital increased more than the general cost of capital, leading corporate venture capitalists to cut more than institutional VCs. So when we asked VCs how companies would be impacted, they thought valuations would be down, but not crashed. They predicted about a 20% drop, more so in early stage than later stage, but not by much. We didn't see a difference between health and IT. That might seem initially surprising, but keep in mind that a lot of the healthcare startups that VCs are funding are in areas that have nothing to do with COVID and might struggle to pivot toward things like COVID. It might not be easy to pivot your startup toward a cancer cure or from a cancer cure and change your focus to hand sanitizer and a COVID vaccine. And moreover, that might not even make sense given the environment that they're operating in. Interestingly, and so let's talk about contracts. Contracts are near and dear to my heart. I've done a lot of work on this area. One of the things that was interesting in COVID, in our survey, is that VCs report that contracts became more investor friendly as a result of COVID, but the levels of contractual terms are still much more founder friendly than they were in our previous survey 5 years ago. So you can see that on this chart that looks at specific terms. Every term on this is a term that will benefit investors at the expense of entrepreneurs. Compared to 5 years ago, VCs say that they're going to be writing contracts that are more generous to entrepreneurs. They think that COVID made things harder for entrepreneurs, but that the secular trend towards more founder-friendly contracts has overwhelmed that. That the penalty of raising money during a pandemic is not nearly outweighing 5 years of tech boom, 5 years of contracts that have shifted more and more towards benefiting startup founders over the people who provide them capital. So one of the big takeaways I got from the results was an increase in idiosyncratic volatility. With every question that we ask, we're seeing a huge dispersion in results. I've been showing you averages so far, but some of what I'm going to talk about now is touching on that idiosyncrasy. We're going to be seeing that idiosyncrasy at the portfolio company level, at the fund level, and it suggests a high level of uncertainty, high level of disruption, and a dispersed impact of COVID. If we ask VCs about their portfolio companies, they say a small fraction are very negatively affected, but most of them aren't really affected at all or even positively affected. This is consistent with a model where you have some venture capital-backed companies, think like online travel agency or anything to do with picking restaurants, the next Yelp. Those might be heavily impacted. On the other hand, you could have startups related to online communication, certain biotech startups that would be massively benefited. We're going to be seeing small aggregate results, but those results are hiding high levels of dispersion within funds. If we look at the fund level, the average effects are small. The average IRR reduction due to COVID was reported to be about 2%, which might sound big if you're used to looking at mutual fund alphas, but this is tiny in the context of venture capital, where the dispersion in return between funds is on the order of 20%. So we saw COVID having a small impact on IRRs and a small impact on cash multiples, which is a term used in venture capital talking about the dollars of value generated relative to the dollars invested. We see this small average effect, but we see high levels of dispersion. If you look at the funds who said cash on cash multiples went down, they say it went down by about 1. If you look at funds that said cash on cash multiples went up, they say it went up by more than 1. So what does that mean? If you think that COVID helped your fund, you think that your investors are getting an additional 100% return. If you think that COVID hurt your fund, investors in your fund are getting a additional minus 85% return on this cash on cash basis. So those are huge numbers. Some VCs believe that COVID was a terrible thing for their investments. Some VCs believe that COVID was good. On average, not much effect. If you look at an individual fund or an individual portfolio company, massive effects. The winners overall offsetting the losers. So in the light of this increase in uncertainty, in this light of this significant shock From lockdowns to fears of death, how did VCs change their time spent? Well, perhaps not as much as you'd expect. They spent a bit more time assisting portfolio companies. They spent less time networking, perhaps because all of these networking things were canceled. They spent quite a bit more time on managing their firm and on meeting with LPs, perhaps reflecting this increased friction in venture capitalist to limited partner communication and the increased concerns limited partners might have in the wake of this increased portfolio company and fund level volatility. If you ask specifically about how they're assisting portfolio companies, they're doing all sorts of things. Over the past 6 weeks, VCs have helped their companies hire all sorts of employees, have helped connect companies to customers, investors with liquidity and COVID relief, have helped provide guidance, both strategic and operational, and helping them reduce burn rate. So VCs claim to be adding a lot of value. What stood out from our previous survey was the increased role of guidance. VCs appear to be putting more effort, spending more time providing guidance to their portfolio companies, consistent with this high level of uncertainty. That might be surprising. You might think that connecting with COVID relief would be something VCs would specialize on, would be able to add a lot of value, or connecting with liquidity, connecting with investors, given the financial intermediation role VCs are providing. But what we're seeing here is that VCs believe that much of their value add is coming from simply being able to provide startups with guidance on the aggregate impacts of COVID and perhaps a broader picture than someone on the trenches might get. A surprising result from my perspective was that geography was not predictive. We did all sorts of measures of local deaths, local infection rates, local case counts, anything that I could find, anything that we could think of. And we saw that being not predictive in the slightest. What results there were seemed to go the opposite direction, with areas that were more affected by COVID having less of an impact on VC than areas that were less affected. So we don't have much power in these tests, partially because of the distribution of the US population and the distribution of VC. VC is overwhelmingly concentrated in a couple of states. If we want to cluster things by locality and half of our observations are coming from the Bay Area, that cuts our power by quite a bit. But an alternative explanation here is that VCs are targeting global markets, and their companies are targeting global markets. If you're looking at the companies that Rob was looking at, where they have a local client base, if you're a restaurant, if you're a dry cleaner, your business might be cratered due to lockdowns. If you're targeting the world, then a local shock, a local lockdown may matter much less. Everyone can telework in, and overall what you're concerned about is not whether your region is in a pandemic. What you're concerned about is what the world's going to look like 1 year from now, and whether people are going to be comfortable flying on planes, or whether people are going to be doing telework, these fundamental economic changes in the longer term. So to tie this back, we were trying to look at one of the main questions in the paper is how investments fell and why investments fell. If investments fell in venture capital, if this flow of innovative financing was cut to some extent, to what extent was this due to a decrease in opportunities? And to what extent was this due to frictions? To what extent does cutting investment make sense? Either because uncertainty is up and we don't want to invest, or because it doesn't make sense to start a startup in a pandemic due to the difficulties in recruiting people, difficulties in coordination. On the other hand, you could imagine investment falling due to what I'd call frictions. Maybe we can't connect with entrepreneurs due to COVID and lockdowns. Maybe our limited partners are calling back capital due to portfolio management constraints. Maybe our own risk aversion has changed. Our results support a role for both, but what I'm seeing from the results is that opportunities played a larger impact. To the extent that VCs were cutting back on investment, this wasn't due to the pipeline getting clogged up. This was due to a change in the economic fundamentals, warranting a pause, waiting, and cutting off some startups that were underperforming. We didn't see a huge increase in IRR. The high level of heterogeneity and impact would mean that delaying makes sense in a real options framework. When VCs said that there were delays, it didn't seem to be caused so much by COVID lockdowns, but more a level of uncertainty and a struggle to relate to deals, evaluate that. We didn't see geographic effects. If you're in an area with strong lockdowns and you're not able to connect in person, that didn't have much of an effect. Those are suggestive of venture capital being reduced not due to these inefficient frictions at the fund level or venture capitalists' inability to adapt to an online environment, but more related to investing being fundamentally less attractive due to this uncertainty shock. So rather than talking about how this contributes to the literature on COVID and entrepreneurship, I wanted to talk briefly about what we're doing for a follow-up survey. We have 3 broad questions that we're hoping to answer. One of them is how investors' expectations were borne out. We asked them about their expectations in the prior survey. Now we're going to ask them about the reality. You expected to cut investment by 30% or 40%. What did you actually do? And how is that related to performance? We also want to ask about changes over time. If we compare your portfolio company interaction in the early stages of COVID versus the late stages versus normal times, are you seeing changes? How has your interaction evolved over the course of the pandemic? Finally, we're going to be asking them a bit of a retrospective. For example, are the factors that normally lead to success, the factors that we'd seen as being important for venture success in our prior survey, are those the factors that led companies to endure this pandemic successfully? Our previous survey suggests that the startup team was the most important factor. Is that still the case? Is the ability to pivot, is the ability to have flexible and adaptable leadership the most important thing? Or has the fundamental risks created by COVID, the fundamental uncertainty there, has that changed what matters in a startup? Does luck, does industry play a bigger role? So to conclude, VC seems to be hurt less than many sectors. This holds despite the importance of in-person meetings in venture capital. If you're not as familiar with the literature, the past papers have shown that in-person interaction, that looking into the whites of a founder's eyes and judging how they are as a person is really, really important to the VC investment process. It seems like that VCs were able to pivot, and rather than looking into your eyes in person, they were able to look into your eyes on Zoom. Why was VC less affected? Well, first might be the nature of the business. This remote work, large cash reserves, a dependence on global market rather than in-person customers. But a more deeper reason might be this optionality. If you're in the business of disruption, if you're in the business of profiting from taking over new markets and expanding markets, being in a situation where there is so much disruption might be a neutral thing or even a good thing. Of course, there are going to be winners and losers, but you can think of many startups in areas like communications and food delivery, which were doubtless dramatically helped by the COVID-19 shock. And this is again consistent with this large variation in impact, with some funds and some companies being dramatically helped and some being dramatically hurt. So that's all I have. I'd love if you have any suggestions on what type of questions we should be asking on the follow-up survey, or anything I can clarify from this. Would love to hear your feedback. And if Ilya and Steve are there, they can also, would be happy for them to chime in to answer any questions.